Hey everyone, it's July 2nd, 2015. In this week's video, I'll touch base on the natural symmetry of the markets, discuss the McClellan Oscillator, and the Summation Index. Drawn here on the daily chart of the S&P 500, I've pinpointed 4 different instances since the beginning of 2014 where the index has consolidated for a month, pulled back anywhere between 4 and 8%, before giving way to a 3-day reversal, which led to an eventual retest of the previous high and a breakout to a new all-time high. Markets, by nature, have a natural order. They're symmetric. What does that mean? It means that in each market cycle, there's a new pattern that emerges. It's up to the trader and to the investor to recognize this pattern and act appropriately. Since the beginning of 2014, the S&P has been in a cycle where the same pattern has repeated on and on. Again, it's what is the pattern? It's a pattern where the S&P consolidates for a month, breaks lower, and then takes 3 days to establish a low before it bounces back up sharply to contest the previous high, leading to an eventual new all-time high. Now, to be specific, not all patterns have to be the same in price and duration. In fact, most patterns are different in price and duration, but they're the same in structure, which is the most important part. Having that said, if you look at where the S&P has traded so far this year, it's been consolidating for more than 3 months. On the basis of symmetry alone, it's reasonable to expect the S&P to establish or to take 9 days to reverse before it springs back up to the previous high, which is currently priced around 2133, and then eventually to a new all-time high. To be specific and to be sure, a symmetry study, whenever you conduct a symmetry study on any composite index or stock, it doesn't tell you anything about where and when price will bottom or top out. It simply gives you a guide or a catalog as to what and how a bottom and top may look like. So, assuming the current cycle we're in the S&P remains, the 3-month consolidation phase we've seen in the S&P all along should lead to a 9-day reversal in the index. Again, whether that happens at current prices or at 2000, the year-to-date low, or at 1960 is a completely different matter that involves us having to take a look at other technical indicators and so on and so forth. But the point of this exercise is to train your eye and to make you aware that in each market cycle, there's one pattern that emerges. It's the same pattern with a slightly different price and duration structure, but the underlying structure that comprises or that makes that pattern unique is ultimately the same. With that said, let's quickly touch base on the McClellan Oscillator. The McClellan Oscillator is a momentum indicator. It basically takes net advances, the 39-day net advances of the market. That's basically takes 39 days worth of advances and subtracts it from the 39 days worth of declines. The result is then put into a momentum indicator or into an oscillator where it gives you a fairly good reading if momentum is present or not. As you can see here, readings below negative 75 usually coincide with a short-term bottom. That signal has a higher degree of reliability if the summation index, which is you can think about it as also a momentum indicator. It's just that it's an aggregate of the McClellan Oscillator. So you get a more reliable signal if you get a reading below negative 75 in the McClellan Oscillator and a corresponding move below 0, which is a value zone on the McClellan Oscillator. Currently, we have the McClellan Oscillator on the New York Composite Index trading at roughly at a negative 18 reading, and the Summation Index at close to negative 400. From a pure price perspective, one would be inclined to say a bottom may be near, but you have to remind yourself that both of these measures are momentum indicators. So, to someone who just saw the S&P break lower from its established range, this is negative. Why? Because it means momentum is negative. So any follow through to the upside is most likely not going to be sold into into the next few days. The only way this reverses is if we see a positive divergence between price and the McClellan Oscillator, or vice versa. Long story short, there's a lot of traders that use the McClellan Oscillator as a basis or a guide to see when and if there might be a short-term bottom in the index. I mean, if you look back at the beginning of 2014, a reading of -50 in the McClellan Oscillator paired with a positive divergence in the summation index, which led to an important low set in February. A similar reading was found in October of last year, where we got an overextension in the summation index with an overextension of the McClellan Oscillator, which gave rise to an important bottom. Today, it's a little bit different. We have a McClellan Oscillator that's not as oversold, but a summation index that is contesting the low set back in September of 2013. So for somebody, trying to pick bottoms in this market, the only way I would say current prices may, possibly serve as a short-term bottom is if there's a positive divergence between price and the McClellan Oscillator. If so, that could halt the descent of the summation index and possibly lead us to trade back to the current range in the S&P between 2063 and 2133. With that being said, I want to thank you for taking time to watch the video. I want to wish you a safe and enjoyable 4th of July weekend, and best of luck trading next week.